Good job.
Always look for those 3 dots. All right. It's 10:03. We will go ahead and get going. Everybody see my screen here in terms of this fancy title slide? Somebody say yes.
Yes.
Perfect. All right. Thank you all for being here. This was actually a pivot from what we were going to talk about today. Usually what we do is we will plan out Wednesday trainings almost a quarter in advance, right? So for example, last week we talked about condo versus townhome. And this week we were going to talk about common first-time home buyer questions. But considering the financial landscape and what we've seen happen over the past week, this is a very pertinent topic. I think this is something that buyers are going to ask about, sellers are going to ask about, regular people are going to ask about when they hear about bank failures. It's been dominating the headlines. So I think we're going to get into the meat and bones a little bit of what's going on with these multiple bank failures and what the fallout might be for the housing market and the economy and things like that. This is going to get a little bit complex. I tried to prevent myself from going full nerd on this bit, but this is somewhat complicated. So if things come up that you don't understand or that you want a more detailed explanation on, just say, hey, Colin, shut up. Can you talk about that in more detail? I'm happy to do it. So let's get going on this. Let's talk about, first of all, so what happened in the past 7 days? This time last week, Silicon Valley Bank in the Bay Area was a well-capitalized institution that had been around for 4 decades, and it was simply seeking to raise some funds. It was looking to shore up its balance sheet, and it made that public. Well, within a 48-hour period, California financial regulators had jumped in and shut down the bank. So this all happened very quickly, Wednesday, Thursday, and Friday of last week. At the time of its closure, SVB was the 16th largest bank in the country. So this was not a small institution by any means when it comes to the banking landscape. In fact, its closure marks the 2nd largest bank failure in U.S. history, behind Washington Mutual in 2008. Friday was not the end of the bad news, because on Sunday, a New York bank called Signature Bank failed, and it represented the 3rd largest bank failure in U.S. history. So everyone was looking around saying, what the hell's going on? And the Fed jumped in and essentially stepped in with emergency funding. They said all SVB deposits were going to be available on Monday. You know, I did something here that I want to fix here real quick. Notice how I changed it. Yeah.
Colin, while you're doing that,
Yeah.
maybe this is a dumb question, but when you say the bank was looking to raise funds, I assume they weren't doing like a charity fundraiser. What does that look like from a bank's perspective?
Correct. So they were looking to sell reissued stock to investors. And then that was the primary capital fundraiser. So what they said is, we're going to try and issue some preferred stock here where we can get more shareholders in the mix to invest in Silicon Valley Bank. And then when you sell those shares to investors, obviously you raise capital, very similar to how IPOs work and how stocks in general work. So that issuing of preferred shares was how they were looking to raise some funds to shore up their balance sheet. The only problem is, when your stock is absolutely tanking, not a whole lot of people want to invest. So problem with that. If you look at these red dots that I somehow drew on, everybody still see my screen or no?
No.
Sorry. Thank you
Nice.
very much. I had written the feds step in with emergency funds. Total pet peeve, which is not a big deal at all, but for me, it just drives me nuts. When you talk about who's raising interest rates, it's the Fed. It's not the feds. The feds are the people that show up at your door when you've done something really bad, right? The Fed is short for the Federal Reserve. So Nicole Junker and I laugh. She'll send me almost intentionally videos of real estate agents usually talking about the feds doing it again, and the feds raising interest rates. Again, feds mean a federal raid, right? Fed is going to be the most common shorthand for that. So I made that mistake, and in typical perfectionism fashion, now I've entirely slowed and stopped the momentum of the presentation just to fix that. So anyway, on Sunday, the Fed stepped in with emergency funding, right? They said, look, we understand this bank closed, but all of your money is going to be available on Monday, right? So they calmed the waters of what was happening here. What they were trying to do, and we'll get into this in a later slide, is stop this whole contagion where everybody is going to run for their money and withdraw it from these different regional banks. It didn't help from a stock market perspective. On Monday, we saw a lot of regional banks get hammered. We're all kind of familiar with TCF, which is now Huntington. I grew up, I had a TCF bank account. I remember selling hot dogs when we had like a neighborhood garage sale, and that was my first bank account, was with TCF, right? And then Huntington bought them. Huntington bank shares were down almost 20% on Monday, I believe. So the markets reacted to, is this a problem in the entire regional banking system? And we certainly saw that reflected in the Monday trading. So let's talk about how this happened. And I'm going to breeze through these slides a little bit, but you have to understand the structure of SVB, which is on the next slide, and then also what happened when people were locking in at 2.75% 30-year fixed. That time of low rates, how that also extends to banks, and how that ultimately unraveled SVB's position and some other banks that were a little bit concerned about their liquidity. So in 2021, Silicon Valley Bank was sitting on a pile of cash. They had a bunch of people that were coming in and investing tech and venture capital funds into their bank. They had so much money that they actually could not lend it out, right? So what they did is they made a traditionally safe investment. They said, you know what? We're going to buy $24 billion worth of U.S. Treasuries. We're going to buy a $250 million of $25 billion worth of of yielding bonds. This is safe. You think about it when you talk about bonds. This is something that you buy, and then in 2 years or 5 years or 10 years, it yields you interest in return. Decently smart move, right? Hey, we're going to store this away in bonds, and we're not going to touch it. And when it reaches maturity, it's going to continue to pay us yielding interest, right? So this is generally considered a really safe investment unless you see interest rates go up, because when interest rates go up, nobody wants your bonds that are only paying you 1% year over year, right? They could go buy 10-year treasury yields that are, paying you 3.5%, or 2-year treasury yields that, as of last week, were paying 5% over a 2-year period, right? So I don't want your low yielding bonds. It's no different than a bank saying, gosh, what do I want? Do I want a 2.5% 30-year fixed rate, or do I want a 6% 30-year fixed rate? What has more value? Obviously, the higher yielding interest product, right? So we saw an historic surge in interest rates, as you are all well aware of, since March of last year. And as interest rates went up, that meant that those low yielding bonds they bought for $24 billion lost money. In fact, those bonds were now worth almost $2 billion less than what SVB paid for them, right? So, not looking like the smartest investment at that point in time. The too long didn't read version at the bottom here is that Silicon Valley Bank went all in on bonds at the worst possible time without a full analytical consideration that rates would go up. And certainly no context of, well, what if rates go up at the fastest pace in history, right? So let's continue to kind of unravel this. Silicon Valley Bank had been around for 40 years. It was not a diversified client base. It was a very tech and VC friendly company that had built a niche in Silicon Valley. They actually serviced half of all VC-backed companies in the United States. So when you think about venture capitalists, they're all connected with each other, they all know each other, and they all talk, right? So when Silicon Valley Bank announced on Wednesday that they needed to shore up its balance sheet, that sent panic through Silicon Valley. And everybody was saying, oh my gosh, this bank is in trouble. We need to go get our money out right now. And when you talk about how much money, customers withdrew an unprecedented $42 billion on Thursday alone. Think about that. That's a huge sum of money that's coming out of this bank, right? Well, now those bonds that they were relying on as a backstop had to be offloaded at that $2 billion discount. And so whenever you talk about $42 billion coming out of a bank in one day, it's very unlikely that any bank, regardless of how well capitalized, any regional bank, not Chase or the big four, is going to be able to sustain that. So by the end of Thursday and into Friday, they had withdrawn so much money, customers had, that the bank was now looking at a negative cash balance of $900 some million. So they were almost $1 billion short of what they needed to cover these customer withdrawals, right? So this was a classic bank run where the bank simply ran out of money, right? I want to talk a minute about how fractional reserve banking works. And I'll try not to put you to sleep here, but the most common understanding of fractional reserve banking is, Ashley, you give me $1,000, right? I'm a bank and you're going to deposit $1,000 with me. I'm required to keep $100 of that 1,000, and then I will lend out that 900, right, to somebody else. I'm going to pay you 2% a year on your $1,000, and I'm going to go make 5% on the $900 that I'm lending to somebody else. And thus I've made 3% on what's called net interest income, right? So when you think about it, Silicon Valley Bank didn't just have $42 billion kicking around, right? They had to make sure that they scrap it together. And this fractional reserve banking system works really well as long as everybody cooperates and has trust in the underlying banking system, right? So, and by the way, there are multiple layers of this, right? Where the person that I lent or institution that I lent $900 of Ashley's money to can then turn around and, they can lend $810 and so on and so on and so on, right? So when you have a bank run like this, it can very much jeopardize the health of the bank because banks aren't necessarily ready for $42 billion to come knocking on their door in one day. Okay. Questions on this before we get into the next slide? All right. As I mentioned, that wasn't the only bank failure that we saw Friday, Saturday, Sunday. Because what happened is that this scared people, right? And fear is one of the most powerful human motivating emotions, right? So there were a bunch of customers of Signature Bank that similarly got scared by SVB and said, what about our money, right? So they withdrew more than $10 billion on Friday afternoon alone. And that was something that that bank could not withstand. Okay. So now what we're seeing is a contagion effect, right? People are getting scared. People are saying banks are failing. What is going on here? How do we get our money out? And banks are not capitalized well enough, most of them, to be able to withstand that slew of deposits in a short amount of time. Right. So the financial markets are looking at this and saying, well, banks have some problems here, right? They have exposure to some of these frothy asset classes that came out of COVID, right? Largely crypto. If you think about, the price of Bitcoin, for example, Bitcoin peaked, I think, around $58,000 per Bitcoin, and obviously has retreated quite a bit. Was trading at $16,000 earlier this year, 2023. Now we've seen a big jump up in Bitcoin because that, ironically, has been a flight to safety. Well, people are saying, well, Elon Musk had a great tweet where, the button back and forth, it's like crypto's a scam, put your money in banks. Banks are a scam, put your money in crypto, which, come on, Elon, like, you're not helping anything here, right? But in reality, we're seeing crypto and tech really slow down. And as a result of that, banks that have made riskier bets on crypto and tech have boiled over. And as such, they're not able to sustain a bank run like this. So the Federal Reserve is sitting here, and Jerome Powell, who's the chairman of the Federal Reserve, is supposed to go to Switzerland on this past Monday. Said, no, I'm going to stay in Washington. We're going to figure this whole thing out. So the Fed stepped in and said, as I mentioned earlier, everybody will have access to their deposits, right? And you say, well, why is that important? Well, when you're talking about Silicon Valley's customer base, the FDIC only guarantees $250,000 of what is in those customer accounts. So if you're a company like Roku, for example, which was a big customer of Silicon Valley Bank, you're sitting here on Friday afternoon saying, okay, we've got $1 million or $5 million in payroll that we have to process for our employees on Friday, and we can't get access to our money, right? And obviously that extends far beyond just Roku. That's a number of tech companies in Silicon Valley that had relied on SVB as their bank. So the Fed jumped in and said, look, we are going to guarantee deposits. We cannot have this whole financial system seizing up, right?
Wait, Colin, I have a question.
Yeah, go ahead.
Okay, do you know why they're going to Switzerland? I'm just curious.
I don't know that. I just know that Powell had canceled a trip over there.
Oh, okay.
If we Google it, we could figure it out.
That's what I was thinking, because they say Credit Suisse is getting crazy now too. And so I'm like, Switzerland, Credit Suisse. I'm like, I wonder if the two connect, baby. Sorry.
Yeah, I don't think it was, we're going to get into that a little bit. And that's a very insightful thought in terms of European exposure. But does everybody understand, sort of when you're talking about real customers and real companies here, like, the thought of, I don't know if my money's safe. I don't know if I'm going to be able to get, imagine you had a $50 million account with Silicon Valley Bank. Is it gone? Like, what do I do with this? And oh, by the way, I have 300 employees that I have to pay on Friday. So that's why the Fed stepped in to calm the markets and also guarantee liquidity in these tech companies.
So, Colin, and again, I know nothing about this stuff, so sorry for the rest of you who may be more.
No disclaimers, no
on this
disclaimers on this training. Don't worry. I mean, there are no dumb questions here.
I have two questions. What's the correlation between the Signature Bank and SVB? Like, what about SVB made people so nervous about Signature Bank versus like Wells Fargo or Huntington?
Signature Bank just wasn't capitalized like you might see a Wells Fargo, right? So when you talk about these big banks, they have the 12 largest banks in America have to maintain a certain liquidity measure, okay? Where they have to have a certain amount, locked up to guarantee that they can sustain a bank run. There used to be more stringent guidelines on how much banks had to have in their coffers that was rolled back in 2018, I believe. So the Trump administration said, we're going to roll back a lot of these requirements for regional banks. But the 12 largest banks, you guys got to stay real liquid. Okay.
Love you.
And so in Signature's case, and it's ironic because anybody know who this gentleman is on the right side here? Bonus points if you know who this gentleman is.
Warren Buffett.
Warren Buffett? Not a bad guess. Jan Cordes. Very good. Barney Frank. So Barney Frank was a longtime senator. He's the architect of a financial legislation called Dodd-Frank, which came out of the financial crisis. And ironically, he's on Signature Bank's board, right? So fascinating in that regard, in that, he's on this board and he is one of the most impactful people in the history of banking legislation through Congress, and that this bank failed. So Cassie, circling back to your initial question, it was simply a fear and contagion issue where, people at Signature said, okay, we need to get our money out too. And Signature was undercapitalized to handle that. So there's no distinct connection other than fear. Does that make sense?
Yeah. And my second question, I just read farther down into your slide and now because I was gonna say, what about FDIC and like how I'm always told my money is protected. But I don't have over $250,000 rolling around in my bank account at this time. So
it's super great because, for me, I'm like, well, this is why we don't have any money laying around, right? We don't have to worry about this. I don't have to worry about this, But I mean, it is sort of interesting when you think about Grant Cardone, talking about going broke twice a year and buying real assets, right? And I mean, I think there's something that could come out of this in terms of, investment in real estate. And yes, we've got 1031 exchange that's on the chopping block. We'll see if that gets through Congress. That's proposed in the president's budget. And that could affect investment properties and things like that. But I mean, I think when you see instances like this, people are saying, well, I mean, I know there's not going to be a bank run on real estate, right? So, I mean, if I've got $250,000, maybe this wouldn't be a bad play to invest in a duplex or a triplex or a fourplex or a condo or whatever, right? So, I mean, I think it'll be interesting to see some buyers that come and say, I'm not super thrilled with the prospect of having $500,000 or $1 million in cash or, whatever it might be. But yeah, the FDIC will guarantee a certain amount. Now, there's been discussion since this week of, is that enough, right? $250,000 is plenty for families, right, and individuals, right? But for companies, especially larger ones, that is an astonishingly low number. And, you know, as you see here, 97% of SVB's customers had accounts that were more than $250,000, right? And yes, you know, you could, for example, set up 10 different business bank accounts that all had $250,000 in them, and you would be protected on each of those accounts. But ain't nobody got time for that, number one. And then number two, you know, a company like Roku, who I'll continue to kind of use as an example here, you know, $250,000 is nothing. It's probably in their marketing budget for a day, right? So it's sort of unrealistic that this FDIC principle that is really designed for individuals applies to companies as well. And there's a little bit of background here too, in that Chris Dodd, who pushed for banking reform, and Dodd-Frank, he's the Dodd to Barney's Frank, right? He said the FDIC shouldn't be overseeing business bank accounts at all. That should be all the OCC. And that was actually voted on the Senate floor, and Chris Dodd lost that vote 90-10. In other words, the Fed wanted to have control through the FDIC. So a little bit of a footnote there in terms of, you know, who's in charge of these business bank accounts. But I mean, you can understand, there's a great, CNBC had a guy on that was saying, yeah, we had $1 million in payroll that we had to process on Friday. And, you know, we had no idea how we were going to do it, right? And essentially, a very wealthy member of this company's board stepped up and personally funded $1 million in payroll on Friday, right? So, I mean, you saw Etsy coming in, and Etsy's like, hey, you know, you may not get your money super fast if you own an Etsy shop, right? That's the kind of stuff that the Fed had to take action on to prevent widespread panic amongst tech business owners. So let's talk about, you know, 2008 versus 2023. Is there a correlation here? Is Silicon Valley Bank the new Lehman Brothers? Parker had a great post last night that we were laughing about. And again, you know, when you put these pieces together, there's a gentleman who is the chief risk analyst, so to speak, if you saw this post in Slack, you guys know what I'm talking about. The gentleman's resume at Silicon Valley Bank, he was in charge of risk at Silicon Valley Bank. And before he worked at Silicon Valley Bank, he worked at Lehman Brothers. So talk about a resume. I don't feel particularly bad for him, considering how much stock was really sold leading up to Silicon Valley Bank folding. But the difference between 2008 and now is, number one, the landscape's totally different, right? So Cassie, this middle bullet point here, the second bullet point, applies to what we're talking about here. So there are increased capital requirements where the banks have to have certain reserve levels that cover, you know, a potential bank run. If you test the limits of withdrawals, banks have to be sufficiently capitalized. The issue is that was rolled back except for a dozen large U.S. banks as part of the last administration, right? So you really only have the 12 largest banks in America that have these rather stringent capitalization requirements, okay? A lot of people have been talking about, if the Fed's going to come in and bail out, which again, we don't use that word anymore, right? We don't talk about bailing out the banks, right? This is a backstop. It's fascinating to see how this is couched, right? You know, the Fed is backstopping this. So, you know, technically taxpayers aren't on the hook. TARP was a $400 billion bailout of the banks. If anybody's seen Too Big to Fail or read Too Big to Fail, essentially they got 10 of the biggest banks in America in a room and said, we're going to give you $400 billion. We're going to purchase preferred stock in your banks. You lend that money out, and we will be non-voting shareholders as the federal government. It was a sort of de facto pseudo nationalization of the banks, where it's like, okay, the government's coming in and giving the banks money in order to shore up their reserve levels, and then also, keep these banks afloat, right? It's interesting in that you hear about this phrase moral hazard, right? Well, if we do this, Silicon Valley Bank, like, how did they get hurt? Right? I mean, the Fed stepped in and backstopped them, so they're not on the hook for, much of this money. I mean, yes, their bank failed, but, there's really no penalty to what they're doing. I would point out that, does anybody know how much TARP cost American taxpayers? It's about $400 billion, right? That was the initial thing, is that, we're going to fund $400 billion into the banks, right? But remember, they bought preferred stock. So American taxpayers actually made about $14 billion on TARP. It's 400 million, I'm sorry. So TARP cost 400 million, and the taxpayer benefited about 35 to 1, right? So TARP was actually a pretty good deal for taxpayers. We talk about bailing out the banks, and nobody likes the optics of that. But the reality is that preferred stock that the government bought in those banks did great coming out of the financial crash. So, there's a question about optics and there's a question about moral hazard, but in reality, TARP was pretty darn good for Joe taxpayer, right? I think the concern is not necessarily who's next in the US. I think the concern would be, to Alexa's point, a global contagion. So people that have the most pessimistic view of what's going on think that, will we see an undercapitalized European financial institution go down, like Credit Suisse? And if that happens, then you've got more of a global contagion that affects the market. But, if anybody's seen The Big Short and these screen grabs from The Big Short, you're familiar with this Jenga tower, right? Which is the packaging of mortgages into mortgage-backed securities, bad mortgages that got bundled together and sold. That's not what's going on, right? I mean, if you think about it, it's not like this $24 billion that Silicon Valley Bank bought worth of bonds. It's not like the bonds failed. It's not like these mortgages, stopped getting payments on them. They started going into default. That doesn't happen with treasury yields. They just simply lost value. So we're not talking about a huge collapse. Alexa, you asked about this question in yesterday's team meeting. You're not talking about bonds failing, right, at 8%. We're simply talking about banks reacting to the fact that they had money in crypto, they had money in bonds, and interest rates rose historically, right? You're not talking about an overall collapse of these mortgage bonds, and where these are going to zero, as Ryan Gosling. That's Ryan Gosling, right? As he would say.
Yeah, that's Ryan. You betcha, Colin.
Hey,
So,
Colin, can
yeah, go
quick
ahead.
question? Because Silicon Valley Bank had all this money that they couldn't loan out, and they bought the bonds. Since they bought it at a historically low time and interest rate, wasn't that kind of risky no matter what? I mean, it's going to go up. That seems kind of like a foolish choice.
Yeah. I certainly think you could make that argument that as the Fed printed unprecedented amounts of money in 2020 and 2021, a smart person would say, well, rates are going to go up. Now, I don't think that anybody anticipated that rates would go up at the fastest pace in history. I certainly didn't anticipate that. I thought we'd be, at 4.5%, 4.75%. I mean, the Fed didn't do its job in terms of maybe we should start hiking rates in 2021. And then we wouldn't have this dramatic climb from 3% at the beginning of 2022 to, 6.5% where we're at now. So I don't think you're wrong in criticizing their strategy. But I also would say, I don't think anybody really anticipated that we'd be sending loan estimates out that said 7+%. I certainly didn't. So let's get to the real takeaway here. And we touched on this a little bit in yesterday's meeting, but dollars to donuts, how is this going to affect interest rates, specifically mortgage interest rates, right? Well, we know the Fed's been monitoring the CPI and the PPI data, which is a measure of inflation. And their biggest focus right now is getting inflation under control. They've also monitored the labor market data. So the big things are CPI data, and then, what's the jobs report say? I noted that inflation came in 6%, right on what we expected, but it's still been sticky. It hasn't been coming down perhaps as fast as the Fed would like. Jobs data has been okay, but is getting a little bit wobbly in the most recent couple of weeks, right? But now the Fed has to pay attention, and its full attention, to bank failures. So a lot of people said the Fed was going to keep hiking rates until something fell off a cliff or until it broke something, right? Well, now it broke something, right? It broke the 16th largest bank in America, and then it broke Signature. And, we saw huge losses in regional bank stocks on Monday. The Fed had to come in and backstop all of these deposits. So this is a giant waving red flag to the Fed saying, maybe you got to go a little lower and a little slower, because everyone really thought after good jobs data in the beginning of February and inflation not really cooling a whole lot in the middle of February, that maybe the Fed would go another 0.5 point next week. Now 25% is way more likely, right? And then, at the beginning of the year, we keep kind of coming back to this thought is, when are you guys going to stop? When are you going to stop hiking rates? And, we had kind of anticipated when rates were back at 7%, the Fed would go 50 basis points, so a 0.5 point in March, and then maybe a 1/4 point in May and a 1/4 point in June. So a full another point, right? Now, maybe they'll only go a 1/4 point, and that might be it. Time will tell, but certainly when you talk about how this impacts interest rates, these bank failures will have an impact on rates coming down. We've already seen that.
So why would they go up at all at this point then?
Why would rates go up at all?
Yeah, why wouldn't they just bring them down? I don't get that.
The concern is that if you bring interest rates down, or if you start cutting rates, Sam, then you open yourself up to inflation exposure. So, for example, if they start holding off on rates or cutting, you would see a concern about, okay, because 6% is still way above where the Fed wants inflation, right? So, they're going to continue to go until they start seeing inflation cooling a little bit. But now they're stuck in a really tough spot, because now on one hand, they're saying we need to get inflation under control, but also look how much we've raised interest rates and look at the effect this is having on SVB. We can't have more banks fail because we're being too aggressive with interest rates to try and curb inflation. Same with the jobs data, right? If the jobs data is good, then they're saying not enough pain has been inflicted. We need to keep hiking rates. Does all that make sense in terms of the interconnectivity? If not, that's okay.
I just don't like it.
I don't think any of us like it, but here's what I will tell you is that we've already seen this sort of have an impact on mortgage rates. So February 3rd is when we got that really hot jobs data, right? We saw interest rates that were peaking below, and PEEK, we're taking a peak below 6%. All right, we saw them shoot up almost 0.5% in a matter of days. Then you see the second red line. This is where we saw inflation data that was not super great for January when reported on Valentine's Day. You might remember this, and this is where I was there in person with you guys in that team meeting where, hey, the CPI data isn't great. Rates are going to continue to climb. You see how rates came up to a peak on March 5th. And then this last red line is some wobbly jobs data last Friday, plus Silicon Valley Bank falling. And you've seen rates, have come down almost 0.5% from that peak. So we've already seen that impact on mortgage rates. Guys, I will tell you, people ask me, I'm a baseball guy, so I like to think in innings. Okay. When will this stop? Because nobody likes it, to your point, Sam. I'm still a believer that we're in the 7th or 8th inning of this thing. Look, the Fed will publicize where it wants the Fed funds rate or where it anticipates the Fed funds rate will be at the end of this year. And it's around 5.25%. So around where it is now. So this idea of rates going to 8 or 9 or 10% is not going to happen. Okay. I mean, I think we are continuing to establish what the peak of this interest rate hike will be, which is around 7.25%. I don't think we're going to see rates get higher than that. And again, you might see rates go up and down in this range, which reflected in this chart is 6 to 7%. But over the course of the year, you will see rates fall. Rates are going to come down. It just might take 6 months. It might take 9 months. It might take 12 months. It might take 15 months. But I think we've established a ceiling. So when you have buyers out there that are saying, when are we going to get to 10%? I think you can confidently tell them that's not going to happen. Right? I think that this is these bank failures are the most accurate representation of these established limits. We can't go any higher, or we're going to continue to break some things. So Amy, good point. 7th inning stretch. Ashley, yeah, there are 9 innings in baseball. 9 innings. Yeah.
I was just going to ask how many innings are there because I'm ready.
I'm like, give me a basketball or a football reference and I've got it.
Sure. Yeah. I mean, I think we've got about 9 minutes left in the 4th quarter. So
I feel like
that can be quite a bit a long time though, too. So,
well, yeah. I mean, imagine no TV timeouts, right?
Okay, great.
Yeah.
I feel like people are asking when are rates going to come down?
Well, I mean, you could tell them they're down 0.5% in the past week. You've been following what's going on with the news. I mean, with these bank failures, the Fed is realizing it can't continue to hike rates at the pace that it did last year. So we're already starting to see rates come down. I anticipate they're going to come down another 0.5 to 3/4 of a point by the end of the year. So we could be sitting in the 5s pretty soon.
I had a conversation with a buyer today who was concerned that more banks are going to start crashing. And then I think some people are thinking that this is going to be a snowball effect and it's just going to be a collapse, but you see this as a pretty isolated event, it sounds like.
I think so. It's a great question, Rachel. I mean, I think that some people will argue Silicon Valley Bank wasn't unique. It was just first. I don't believe that. And I could be totally wrong. The advice you're paying me for is exactly what it costs to get on this call, which is nothing, right? But if you think about it, it was unique in that all these VC guys, Wall Street Journal had a great piece about how, Silicon Valley turned on Silicon Valley Bank, right? This bank that had lent them money and supported them through 40 years of tech startup growth in Silicon Valley, and they all pulled their money out at the same time. That kind of sucks, right? So, this customer base all spoke to each other, right? There are a bunch of venture capitalist guys. And so when it affects one and people start talking, you will see a historic run of $42 billion that is withdrawn in a single day. They did not have a diversified client base, right? They were all focused on tech. And so, to my point about selling hot dogs and, going to open my first bank account at then TCF, I don't think anyone would argue that Huntington does not have a widely diversified client base, right? Are
Hey,
there some
Colin?
banks? Yeah, go ahead.
Maybe stupid question, because seriously, you might as well be speaking Chinese to me right now. But if they're all pulling their money out, they're not like stashing it in their pocket. They're putting it somewhere. So aren't they putting it back into another bank?
Yeah, that's part of it. Yep. Or what are they doing? They're buying bonds.
Oh,
right.
Okay.
And so when they buy bonds at these higher yields, that's good for interest rates. Because
Stocks and bonds
yields
now. Okay.
Yeah.
Yeah. Now I get it. Okay.
Yeah. And without getting
So
really technical, go ahead.
Now the people that put their money in the bank that bought the bonds at a low interest rate and lost their money are now able to buy the bonds individually at the high interest rate and make more money.
Yes.
Beautiful. I love America.
Yep. Yeah. Capitalism, right? Yeah.
I have another dumb question.
No such thing. Go ahead.
Why the tech industry? Like, I don't get it. Like, I feel like the tech industry is like a good industry, like pretty bulletproof.
Yeah. I mean, I think you've seen huge layoffs at Meta and Google, and
I don't get why though.
Why there are layoffs?
Yeah.
Well, I think that anybody know anybody in the mortgage industry or real estate industry that's left the industry? Right? We all do. I will speak from a mortgage perspective that, it was going gangbusters in 2020 and 2021. And you could not hire enough underwriters. You could not hire enough people, right? And the stock market was at all-time highs. There was cheap money. It was a very interesting environment. And now the music slowed down, and no different than companies we're seeing across the US. As that music slows down, companies are forced to cut. Right now, in Meta's case, they did a bunch of dumb stuff, right? And not to sound like we're on Squawk Box here, but I mean, like, why did they call it Meta? I mean, that's just dumb, right? I mean, the VR, like the what's it called? The verse, what is it? The metaverse, right?
Metaverse.
I mean, like, why would you jump in and so yes, Sam, I don't think that you're wrong in that tech is somewhat bulletproof, but the reality is that tech is cutting a bunch of jobs, falling from this 2021 peak.
And so if it's tech companies that are in Silicon Valley, are entertainment companies, do they go somewhere else? Are
You mean like LA?
Yeah,
Hollywood?
I mean, tech companies aren't the only ones with money, or are they the only ones with money in that bank?
Primarily, right. So this was, tech made up a huge portion of their client base, right? They had a niche, right? I mean, if you think about anybody who'd done agricultural funding, right, where it's like, hey, we need to do farm lending, right? People come to me to do that. I'm like, well, you're gonna call AgStar, right? Or call this particular bank because
fair.
they do that kind of lend. Same kind of deal, right? So one VC guy says, I got $100 million in funding from Silicon Valley Bank. they speak our language, they know what's up. You should go talk to Silicon Valley Bank. Before you know it, Silicon Valley Bank has a niche in the tech industry, which is great, till you realize they don't have a
Like
lot of
piss 'em all
mortgages
off.
that they hold on their books, or they don't. Right. And then thinking, oh boy, if one person gets infected with this message that we're in trouble, we're going to see 42 bill go out the door in one day. Jennifer, you had a
I'm
great
glad
question.
I only
So
got $10.
yeah, exactly. To simplify for me, rising rates is to slow down the economy and create less demand for products and therefore lower prices. Is this because of the slowdown during COVID and the stimulus worked too well? Spot on. That's a great explanation.
Okay, I just wasn't sure if I was getting it, the overall big picture of why this is kind of all happening.
Yeah.
So is that what we should be telling people? Like, I need like a dumbed down synopsis of what we should be telling people.
That's what I was going for.
Yeah, like what else? I mean, is there anyone else that has been getting these questions? I know Rachel did. Like, I don't want to sound like an idiot if someone asked me about this stuff.
I feel like it's the same conversation though, really. It's no different than, this is one example of it, but the bottom line now still relates to when the rates are higher, even though it's a little bit more inconvenient to purchase, you have less competition. The minute those rates go down, you're welcome to, the ridiculous multiples. We're already seeing that happen a little bit just in the weeks that we're having the ups and downs. So I think really doesn't matter what the what is, as long as we keep bringing that conversation back to the now. Doesn't matter. When I just purchased a car, I didn't care what the rate was. I cared what the payment was.
Boom.
And so I usually just kind of, because I don't know a lot about that, I just bring it back to that basic, which really doesn't matter why. Does the payment fit? And if the payment does fit, then would you rather get it now when we can negotiate, or in 3 months when you got to sell a kidney? And I literally say it like that. And they usually say, okay, now.
To follow up on Jen's point, like I agree with you, Sam. This stuff, like, I mean, this was very informative. And I got some pieces from it, but anyhow, like, I don't know that it's necessarily our responsibility to explain this to buyers. Like, I think it's just back to what Jen said. And also, like, pretty much everything I've shown my buyers lately are still going in multiple offers. So right now, everything's going in multiple offers. And furthermore, what caused our housing crash last time does not exist right now. That, what caused that whole housing crash in 2006, 7, 8 is non-existent right now. And people still have a ton of equity in their home. So if that's something you're going to be waiting on, you're probably going to be waiting a real long time. And I can reflect it back to, that's really interesting. I had people tell me that in 2020 too. And guess what? That same house they were looking at in 2020 that they waited on is $50,000 more now in 2023. So if you want to wait till 2025 and pay another $25,000, and that kind of gets them thinking too.
The reality is, yes, we have an affordability problem in terms of rates, but we are a payment-driven society. Jen, you're absolutely right. What's my payment going to be? That's what I care about, right?
I'm gonna say I've never had, when I bought in cars, I don't even know what my interest rate is.
Right.
Right? You don't find out till the end, and then you're like, oh, that
I don't think they've ever
okay.
even told me.
And that's because
And
the media
Colin-
doesn't focus on interest rates for cars. They focus on rates for houses.
Mm-hmm.
I think it was you in the beginning when all this started, probably about a year ago, I would say, that didn't you have a slide somewhere that showed that consistently through the years we've seen a 3% increase no matter what's been going on
In housing?
Mm-hmm.
Yeah. I mean, I also am thinking of a slide that we did last summer that probably exists somewhere of the crash bros through the years, and what the crash bros were saying about why the market was going to crash in 2013 and 2014 and 2015 and 2016 and why it didn't happen. And I'm going to bring that back to life because yes, we have an affordability problem in this market, but I'm going to say this really slowly and really definitively. Nothing is going to change until we fix the inventory problem.
I want to record that in his voice and play that for my clients.
Because why are we seeing multiple offers? It's because there are too few homes and too many buyers, period. Right? Now, builders have said they're done. Multifamily is a little different, but single family housing starts have been horrific at it, right? They're not going to do anything until interest rates rise. So that's not going to solve our problem. And, you know, my parents are 67, 68 years old. You know, they're hanging on to their property for a little bit longer, right? We also have all these people that bought at 2.875% that are becoming accidental landlords. Why would I give that up? I'm going to make money. I'm going to cash flow this property. I might do a HELOC or a bridge loan. I might get some of my money out, you know, but so until inventory improves, you're still going to have too few houses and too many buyers. And that's how you get multiples, right? Everyone thought rates go to 7%, things are going to crash. Well, we're there and we've been there for 4 months now, give or take.
Well, and the fact remains that during that time.
All right, guys. Hey,
No, guys.
I'm sorry to interrupt.
Well, if you have any
It's
more
4 o'clock.
questions on this stuff, feel free to do it in the Slack channel. Ask the lenders. Colin or I will respond. I know you guys have a
1 o'clock.
1 o'clock. So for the
You guys so
Real
much.
quick.
This is awesome.
Thanks, everybody. This was really great. I appreciate you guys.
Thanks, Colin.
Thanks, Colin.
Colin, you can stop recording now too.
Oh, okay.